How does the housing market actually work in 2025? And why are so many Americans feeling completely stuck right now? Like financially handcuffed to their homes, stuck. Like watching your neighbor list their house and thinking, I'd rather eat glass than try to move right now, stuck. We're in one of the most challenging housing periods in modern American history. Understanding how we got into this mess is the only way to figure out how we're getting out. For over a decade, from 2009 to 2022, interest rates stayed historically low, below 5.25% for 13 straight years. Most people didn't realize they were living through an unprecedented era of cheap money. The Federal Reserve kept rates low to help the economy recover from the 2008 housing crash. And it worked, maybe too well. During this time, especially between 2019 and 2022, millions of Americans locked in mortgage rates between 2 and 4%. These weren't just good rates, these were unicorn rates, once-in-a-lifetime rates, rates our grandparents would have literally fought wars for. But by leaving rates so low for so long, home prices started climbing. Basic economics, right? When borrowing money is cheap, more people can afford to buy. More buyers competing for the same number of homes means prices go up. In many markets, home values increased 30 to 50% between 2019 and 2022 alone. That 3-bedroom ranch your neighbor bought for $250, suddenly worth $375. Then came 2022. The Federal Reserve looked around, saw inflation running wild, and realized things were getting out of control, so they raised interest rates. But they didn't ease into it like a cold pool. They cannonballed. In April of 2022, the average mortgage rate was around 3.5%. By October of that same year, rates had shot up past 7%. In just 6 months, mortgage rates more than doubled. Let me show you what this means in real numbers. Take a $300,000 loan. At 3% interest, your monthly payment is about $1,264. At 6.5%, and where rates are sitting in 2025, your payment jumps to about $1,897. That's over $630 more every single month for the exact same amount borrowed. That's a car payment. That's groceries for a family. Now let's talk about the trap. Imagine you bought a home in 2021. You got a great rate, let's say 2.75%. Your home has probably increased in value. Maybe you have $100,000 in equity. That's fantastic, right? You're building wealth. But here's the problem. You want to move. Maybe you need a bigger house because your family's growing. Maybe you got a job opportunity in another city. So you look at selling your house and buying another one. You'd walk away with that equity, which is great. But then you realize something terrifying. To buy your next home, you'd need a new mortgage at 6 or 6.5 or maybe even 7%. Suddenly, even though you have more equity, your monthly payment would skyrocket. You might not even qualify for the loan you need because the higher interest rates mean higher payments. You're sitting there with $100,000 in equity feeling broke. This is what experts are calling the lock-in effect. According to recent data, about 82% of homeowners with mortgages have rates below 6%. These people are effectively locked into their homes, not because they can't sell, but because moving would mean financial suicide. So how did we get into this mess? 2008 brought the housing crash. Banks were lending money to anyone with a pulse. Subprime mortgages collapsed. The economy tanked. To fix it, the Federal Reserve dropped interest rates to near zero. This encouraged borrowing, spending, and investing. It worked. The economy slowly recovered, but they kept rates low through 2010, 2015, 2020. Even when the economy was doing well, rates stayed down. This created an environment where asset prices, including homes, kept climbing. Then COVID-19 hit in 2020. The Fed dropped rates even lower. Mortgage rates hit all-time lows, 2%, sometimes lower. Home buying went into overdrive. Bidding wars became normal. Waiving inspections became normal. Offering $50,000 over asking became normal. But all that cheap money created inflation. By 2021 and 2022, prices for everything were rising. The Fed had to act. So in 2022, they started the fastest rate hiking cycle in 40 years. And that's where we are now in 2025. Now let's talk about solutions. If you have a low-rate mortgage and want to move, You have options. Option one is to keep your current home and rent it out. If you can qualify for a second mortgage, you could buy your new home and become a landlord. Your tenant pays your low-interest mortgage while you move on with your life. Option two is the assumable mortgage. FHA, VA, and USDA loans often have assumable features. This means a buyer can literally take over your existing loan at your existing rate. If you're selling to someone who can assume your 2.75% mortgage, your home becomes incredibly attractive to buyers. Option three is to wait and save aggressively. Use this time to pay down your mortgage principal, save a larger down payment, and wait for rates to potentially drop. The Fed has hinted that rates may come down gradually if inflation continues to cool. Option four is seller financing. If you own your home outright or have significant equity, you could offer to finance part of the purchase for your buyer. This is more complex and requires legal help, but it's an option many people don't know exists. What about first-time buyers in 2025? Start with education. Understand what you can actually afford. A good rule is to keep your housing payment below 30% of your gross income. Look into first-time buyer programs. Many states and cities offer down payment assistance, lower interest rates, or tax credits. HUD has resources. Local housing authorities have programs. Consider different types of properties, maybe a condo or townhouse instead of a single-family home. You don't have to buy your forever home first. Your first home doesn't need to be perfect. It needs to be yours. And remember, you can refinance. If you buy today at 6.5% and rates drop in 3 years, you can refinance. You're not stuck with your initial rate forever. Will there be a housing crash in 2024 or 2026? Most experts say no. A housing crash requires forced selling. In 2008, people couldn't afford their mortgages. Today is different. Most mortgages are fixed rate. People locked in low payments. Even if home values drop slightly, most homeowners can still afford their payments. Plus, we have a supply problem. America is short somewhere between 4 and 7 million housing units. Limited supply keeps prices stable or rising, even when demand softens. Could prices come down? Sure, some markets might see 5 or 10% corrections, but a crash like 2008, very unlikely. What about rent versus buy? Renting gives you flexibility. No maintenance costs, no property taxes, but you're not building equity. Buying builds equity. It's forced savings. You get tax benefits, but you need a down payment and you're responsible for repairs. In most markets in 2025, if you plan to stay somewhere for at least 5 years, buying makes financial sense. If you're uncertain about your location or career, renting might be smarter. There's no shame in renting. Here's what you need to understand. The current housing market isn't broken, it's adjusting. We went from an abnormal period of ultra-low rates to a more historically normal environment. Interest rates in the 6 to 7% range are actually pretty typical. For most of American history, this was considered good. Our expectations got skewed by a decade of emergency monetary policy. The lock-in effect is real, but it's temporary. As rates normalize and people adjust, mobility will return to the market. It might take a few years, but it will happen. Life doesn't stop just because interest rates went up. The housing market in 2025 is challenging, but it's not impossible. Whether you're trapped in your current home, trying to buy your first place, or just trying to understand what's happening, knowledge is power. Understand the economics, know your options, make informed decisions. Don't panic. Don't wait for a crash that probably won't come. That's how you win in any market.